Now, to think about this, let's first just think what a mock bank statement looks like. So this is going to be a bank statement, usually has like a beginning balance, your additions, and then your subtractions, and then the ending balance, and then it breaks out all of the detail of the increases or deposits, and then the decreases, which would be checks, or these days, most likely electronic types of transactions for the decreases. Okay, so that means that if I pull this information in from the bank, what it's going to give me is just this information. It's going to give me the information that the bank has. And that could be more or less detailed depending on the type of industry that we are in. So in other words, on the deposit side, where do deposits come from normally from a business? Hopefully, customers. So hopefully all the deposits that are coming in, we can, on the most simplified type of system, we can say that should be revenue. It's coming from customers, so I can assign it to an account of revenue account if I was in a simple system such as gig work, such as working at like YouTube or something, and YouTube is paying me or Google's paying me, and then I might be able to assign that out pretty easily. But the bank only has the date and the amount. Now, so for example, if you're in a type of company where you actually make sales at a cash register or something like that, you take the cash, go to the bank, deposit it into the bank. What does the bank know? It knows the date of the deposit, and it knows the amount that you deposited into the bank. In that case, it doesn't know all the individual sales that you made because you made that outside of the bank. It only knows the amount that you deposited. So you can imagine in that situation, you're probably going to want to have more of an internal control over the check register to make sure that you're recording the sales as they happen at the register. So that's going to be like the added problem that you might have in that system, right? But if you have electronic transfers, like you're getting paid from YouTube or some kind of platform, then the bank also knows where the information came from. So they're going to give you in the memo, possibly the customer in that case, which might be like a YouTube or something like that. If you're getting electronic payments from actual customers, then it might give you information about the customers in some cases, in which case you can add the customer, tracking not only the fact that you got revenue, but you got information from a customer. What about the decreases? Money going out of your account. What happens to that? Well, it's usually going for expenses. So that's going to be your utility bill, your rent, and so on and so forth. Now, if you actually write checks, then it's going to be a little bit more difficult to just automate things with the bank feeds, because if you still write checks, then what happens when you write the check, it doesn't clear the bank. The bank doesn't know about it until the check clears. When the check clears, that's when the date is going to be recorded. So notice you have a timing difference. You have a problem there that when you wrote the check, they didn't know about it until it cleared. And so that's going to be an issue. So that means that if you still write physical checks, then you're not going to be able to automate everything typically with the bank feeds, because what you want to do is track the checks that are outstanding, which the bank doesn't know about, right? However, many businesses are automated these days, so you pay everything electronically. If you pay everything electronically, then the date is pretty close to the accurate date. And you don't have a check number, but then you have the amount. So once again, you have the date and the amount on the increases and the decreases. So how does that translate over into QuickBooks? That means in bank feed limbo here, you're going to have the increases and decreases. And then if there's electronic transfers, you're going to have the bank memo to help you possibly determine what account it should go to and possibly add the customers for increases and the vendors for the decreases is going to be the general idea. So that at the minimum is what you'd need to know for a very basic cash-based accounting type of system. And what forms is that tied to? Well, that means that the only two forms you would be using in that very simple case would be basically a deposit form, which you're going to use to increase revenue, basically, which is not exactly how the deposit form is usually used in QuickBooks, but it works that, you can make a system that way in some cases. And then there's going to be decreases, which are expense forms, which are kind of like a check form without the check number. So even when you use bank feeds, you're still going to use these forms. And therefore, if you have a very simplified cash-based system where you have gig work or something like that, and you don't have to deal with accrual businesses, you at least want to understand what the expense form is and what the deposit form is, because those are the two forms that you will typically be generating when you create your transactions using the bank feeds. Now, you're also going to have an added problem that you have to think about this beginning balance, because usually when people start the business or start their QuickBooks, you have this beginning balance issue. And the question is, do I want to go back in time prior to the last year and pull in all of the transactions, or do I want to just enter the beginning balance and track the current information going forward? We'll talk more about that in our practice problem scenario as well. Typically, you want to have at least an entire full year in one accounting system, whether that means that you have to run like a dual system side by side with another accounting system, or start the cutoff at the current time frame, so that when you at the end of the year need to do taxes and or financial reporting, you don't need to tie together two different accounting systems, because that's ugly, that's messy to do. All right, so that's going to be the general idea. Now let's